Inflation has surged to its highest level in almost 40 years. Let's talk about not just what you need to do to hedge yourself against it, but actually profit from it. The annual inflation rate is now 6.8%, up from 6.2% year over year last month. This is going back to the year 1982 when we last had inflation that was this high. Yes, Ronald Reagan was president. Yes, Michael Jackson released the hit song Thriller back in the year 1982 when inflation was last this high. In fact, this was 1 year before the Return of the Jedi movie came out and Luke took the mask off Darth Vader. Yes, it has been that long since inflation was this high. I'm Keith Weinhold. This is Get Rich Education. If you're younger than 40 years old, you've never experienced high inflation like this, not at all in your life. Shall we say the Millennium Falcon has hit inflation hyperdrive now. So the effect that this has is therefore your $100 bill, which looked the same as it did 1 year ago with Benjamin Franklin's portrait on it, now has the purchasing power watered down 1 year later to $93.20. That's the problem here. Inflation destroys your purchasing power. Inflation impoverishes you. And you know the thing is, and this is really important, inflation is a stealthy thief. Some people think taxes are an obvious thief, but the reason that inflation is a stealthy thief is because you've seen things like a tax bill before tangibly with your own eyes, even when you have taxes deducted from your paycheck. You've had a credit card bill. You have an electricity bill. That's tangible. That's something that you can see. But inflation is a silent thief. You can't see it. You've never seen an inflation bill in your entire life. That's why this awareness is so important. Just last year, economists predicted 2% inflation for this year. Wow, were they wrong? So let's go ahead and take a look at the historical context for this some more. Then we're going to talk about how it impacts you. And finally, by the end of this video, I'm going to talk about an action that you can take, what action you definitely don't want to take, and the action that you do need to take is how you can profit wildly from inflation. In fact, you can 6x inflation, achieve 600% of inflation because of inflation. That's what you're going to learn by the end of this video. So as we look at the historical context here for fitting in this 6.8% CPI inflation, we go to the historic chart here ever since the 1940s. You can see the post-World War II era gave us a really high spike in inflation. So did the Korean War. Wars often lead to inflation. We had a substantial economic expansion in the late 1960s, but their inflation wasn't as high as it is now. We had the oil shocks, Iraq invading Kuwait later there in the 90s, a gas price spike, but even that back about 15 years ago wasn't as substantial as this amount of inflation that we have now. Understand, look at the period of the 1970s. We had almost decade-long high inflation there. In fact, the inflation average of the 1970s was 7.1%. Property prices, by the way, gained 9.9% for that decade. That's a little bit foretelling of what I'm going to show you later in how to profit from inflation. An important thing for you to remember is inflation widens the gap between the haves and the have-nots. It narrows the middle class, and unfortunately, more people from the middle class go toward the have-not category, and fewer people from the middle class figure out how to escape and get into the haves category. That's what we're talking about today. And in order to understand why inflation hurts poor people, the have-nots, more than it does the haves, is consumer spending patterns. I mean, a greater proportion of a poor person's disposable income goes toward what we would think of as everyday consumer expenditures. So if someone's weekly grocery bill goes from $150 a week to $200 a week, well, that really hurts the people over here that don't have much. The wealthy are pretty impervious to that. So many in the middle class and the poor, they are not. They are affected by that. We're talking about the cost of groceries. We're talking about the cost of gasoline. We're talking about the cost of even housing, much of which is not accurately reflected in the CPI. That's why many feel real inflation is higher than 6.8%. The cost of heating your home, that affects poor people more. In fact, natural gas prices, for example, are up 25% year over year. This really hurts people that have less. It also hurts people on fixed income, like seniors or people that save, oftentimes that are seniors, that used to learn back in the day that it makes sense to save when bank accounts gave you a real yield, but that hasn't been true for decades. And you know, a lot of those older people, those seniors, those savers, they did what they learned that they were supposed to do, and they delayed gratification and they saved. Well, inflation transfers wealth from savers to borrowers. Now, for the middle class, inflation is not so great. It's not as bad as it is for the poor class. When prices outstrip wage growth, if middle income people's wages don't keep up proportionally with that higher income, then they've lost purchasing power and prosperity, despite what number of dollars they have in their account. Their standard of living falls. But you know what? The middle class does have a few investor dollars to place that the poor class doesn't. So we're going to talk about how you can do that. Hey, go ahead and put a YouTube like on this if you would, because I swear by the end of this video, you might actually like inflation, as strange as that sounds, so I'd really appreciate the YouTube like. Now understand that over the long term, 2% inflation has been desired from the powers that be, from the Fed, the ones that make the monetary policy. They've been open to having it go above 2% lately, but they don't want it as high as 6.8%. Let's talk about how inflation can put money in your pocket and when inflation takes money out of your pocket when it comes to investment classes or just where you park the dollars you have at all. And there isn't much work for you to do here to profit from inflation. But first, let's talk about these other asset classes. Many of them are what not to do. In real estate, if you do it right, you are winning huge with inflation. We'll talk about that in a moment, but understand that inflation actually diminishes the value of your real estate equity. Equity being the amount of home or property that you own minus O. So if you have $100K in equity at 7% inflation, that gets watered down to having only $93K of equity and purchasing power after just 1 year. So within the real estate world, equity is hurt by inflation. Stocks are hurt badly. The long run average of the S&P 500 being something like 10%. Well, if you have 7% inflation, which is about where we're at today, you're down to a 3% return. We haven't even talked about the other drags on stocks like taxes and fees and volatility in addition to the inflation. Inflation hurts stock investors. You're not going to get ahead that way over the long term. Of course, holders of bonds and savings accounts are hurt badly. Oftentimes, your yield can be less than 1%. You're really losing when you're in these vehicles. You probably want to keep a little liquidity around, but not much. What about gold? Gold is the classic inflation hedge. Just look at a chart of gold. Over the last 10 years, gold hasn't gone anywhere. And over the last year here, if we just look at that with gold, it's had a chance to respond to inflation, and it hasn't done anything at all in the last year either. What about Bitcoin? Would that be a good place to put some of your money in periods of high inflation? Well, maybe. In fact, Bitcoin's unique selling proposition is that it has a fixed supply. There will never be more than 21 million Bitcoin, 19 million of which have already been mined. So some people like Bitcoin. If you trust it, there is more upside and there is more risk. And Bitcoin is not as dimensional as what I'm going to show you with how to profit wildly from inflation. What about being a lender? Like, I'm a private lender on a little bit of real estate, though I'm mostly a real estate borrower. If you have an 8 or 10% yield and inflation's 7, you've beat it by a little bit if you're a private lender. What about taking your dollars and use it to pay down debt? That is an awful time to do this in the cycle. You don't want to make any extra principal payments when inflation is higher than the interest rate. That's a very poor allocation of your capital. The way to crush it, the way to really profit from a high inflation environment is to buy a rental property that cash flows with a loan, a 30-year fixed rate mortgage. You're winning so many ways at the same time. You're totally crushing it when you do that. Let's talk about how. And you know, there are not very many guarantees in investing, but when you do what I just said, borrow for cash flowing real estate, you're kind of making the long-term bet that the dollar is going to go down. That's an almost certain bet. Over the last 100 plus years, a dollar has lost 97% of its purchasing power. Almost everyone thinks that trend is going to continue. You're able to invest in something that's nearly guaranteed the diminished purchasing power of the dollar when you borrow big like you can with real estate. understand that we're in somewhat of an inflation inversion. In fact, interest rates are usually higher than inflation. Well, right now, 6.8% inflation and 3.1% just on a 30-year fixed mortgage. That means inflation is more than double interest rates. Think of how odd that is. Typically, a bank would want to get a yield above and beyond inflation. If inflation is 7% like it is today, a bank would want to charge 10% because they need to get a real yield of 3%. That's inverted. That's flipped. Banks are losing when they lend money to people like you. And the Fed needs to raise interest rates in order to control inflation and get on top of it. That is their classic tool. And when you borrow money from the bank, what this inflation inversion means is that you get to pay back the bank with dollars that get debased on them more than twice as fast as their interest can accrue on you. Inflation 6.8, mortgage interest rates are 3.1. You're winning. And with higher interest rates, housing prices typically go higher. I know that's counterintuitive. I'm not going to get into all that. I've talked about that on previous videos, but the short story is the last 6 times that mortgage interest rates rose, which has happened 6 times since 1994, housing prices rose every single time. We're setting up to have the same thing happen again over the next year or two with higher mortgage rates and higher prices. So let's get to it. Let's get to this actionable part. And there are a few numbers floating around here to really make this concrete and tangible. And if you don't like numbers too much, I'll tell you what, numbers get a lot more interesting in 2 ways. We put a dollar sign next to the number, and these dollar signs signify your dollar signs and what you're able to do with your money in a high inflation environment. For the first time ever, we're going to take this example of the inflation triple crown, a phrase I coined to talk about the 3 ways that you simultaneously profit with real estate this way. Let's just say you bought a rental single-family home for $200,000. We'll even give it an address to make it a little more real. We'll say this is at 432 Mockingbird Lane, and it's a green rental single-family home. All right, let's apply 10% inflation over time to this. The stated rate of inflation isn't that high, but then at 7% inflation, maybe say it would take about a year and a half to get 10% inflation. Let's use 10%. So here, the first way that you win by buying cash flowing real estate with a loan is with price inflation. We'll say that you buy a $200,000 property. We talked about how you want to get a loan. You're going to have to use a 20% down payment, so you have a $160K loan, and therefore you have $40K of equity on the day that you buy this property. Well, after 10% inflation, you now have a $220,000 property. Your loan is $160K, therefore you have $60K in equity. Well, wait, after 1 year, you went from $40K in equity up to $60K in equity? Yeah, you have a 50% gain in your equity from 10% inflation. You just 5x'd inflation. We're not done. This is only the first of 3 legs of the inflation triple crown. The second is debt debasement. All right, on this $160K loan that you've got on this green property here on Mockingbird Lane, after 10% inflation, whether that takes a year or a little more, your loan really only has $144,000 of debt burden on you in real dollars. See, because after 1 year, wages are higher, prices are higher, and your bank does not ask to be repaid in inflation-adjusted dollars, only nominal dollars. Nominal means in name only. They're only going to ask back for the same $160K. You're winning with debt debasement. So the result is that's another 10% gain from inflation profiting. And the third leg of the inflation triple crown is cash flow enhancement. Let's say you have a $1,600 rent on this property. Yes, you can find properties for $200K that rent for $1,600. And these are your typical expenses. You've got your principal and interest amount, vacancy, insurance, maintenance, taxes, no utilities. A tenant pays those in a single family home, and your property management in order to make this passive. All right, so on the day you buy this property, that leaves you with $150 worth of cash flow. Let's look after 10% cumulative inflation over time, which at this rate takes less than a year and a half. Your rent is able to go up to $1,760 because you raised your rents to make them commensurate with prevailing inflation. Your principal and interest payment stays fixed at $750. That doesn't go up. This is huge. This is key. And we're going to say that all of your expenses do go up by that 10% inflation. All of your other operating expenses. Operating expenses are all the ones beyond the principal and interest. They all go up at 10%. That leaves you with $240 cash flow. So here's the real epiphany. You had $150 cash flow just a little over a year ago when you bought the property. You're up to $240. Your rent income, therefore, just went up 60%. Even during a period where inflation was only 10%. You just 6x'd inflation. How did that happen? Again, it's because your principal and interest payment stays fixed. And maybe you're thinking, oh, well, that's only a $90 increase, though. What's the big deal? No, extrapolate that 60% gain effect across your entire portfolio. And you can see the power of how this greatly magnifies wealth with the inflation triple crown. So let's round up your returns. And you know what? Before we round up all your returns here and kind of add them up, go ahead and put a like on this if you're learning something. If you like seeing how the inflation triple crown applied to real life can substantially magnify your wealth, especially in a higher inflation environment like this, I'd really appreciate the like. So you're rounding up all these returns. Let's tally it up. With 10% inflation, you have a 50% gain in your equity from price inflation, a 10% gain from your debt. Remember, that's called debt debasement, and a 60% gain. This is the most important one as well, in your income, your cash flow, the money in your pocket, your tenant's rent income minus all of your expenses. That's known as cash flow enhancement. You're rounding up all these returns. That is the inflation triple crown. And if you want to learn more about that, go ahead and check out my short playlist where I really go deeper into the inflation triple crown and how to optimize it. It is just a great free education, a short 3-video playlist. And this is more germane than ever. This inflation triple crown series, as inflation is now clearly a more persistent economic malady than almost anyone thought just a year or two ago. And you know, the great thing about that series and with the math I just showed you is there's no complex math. That's how it works in real estate investing. It's just addition, subtraction, multiplication, and division. No trigonometry or calculus or exponents. This is easy stuff. There's nothing cutting edge here. This isn't real estate investing where you have to pioneer in the metaverse or buy an NFT and get all educated on that. This is really simple stuff, and it's also generationally proven. There's nothing new here. This is just how this has worked for generations. This is a huge reason, inflation, why real estate's made more ordinary people wealthy than anything else. A lot of people just can't really explain to you just how that happened. And when you understand how it happens, you know how to optimize things and how to position things in your portfolio, oftentimes such that you'll have less equity and more debt as long as that debt is reliably outsourced to tenants. I buy my own property. Yes, you can find properties conducive to this at a place like greturnkey.com. Turnkey means a property that's already renovated, already has a tenant in it, and is already under management, so it's passive and cash flowing from day one in a lot of instances. It was 1970s futurist Buckminster Fuller that said, "Don't fight the forces, use them." You're not going to lower American inflation yourself from 7% down to 3%. So instead, just align your interests with the behavior of the government and what they're doing. That's what you do. You don't fight forces, you use them. Learn how to use inflation to be a profiteer. The short story, the summary is that inflation is high. Inflation hurts consumers and it helps the investor class. So what you need to do is turn your consumer dollar into an investor dollar. There's no better way to do that than with cash flowing real estate tied to long-term fixed interest rate debt. Check out greturnkey.com if you want to position yourself that way as well. I'm Keith Weinhold. I really appreciate you being here. But again, you weren't here for me. You were here for you. We'll see you in the next video.